China's economy is warning of a global recession, why the debt ceiling is bond bullish, and how higher prices are going to destroy the manufacturing sector. All that and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today, because this China story isn't just an Evergrande story. It's a global economy story, because I want you to be thinking that the world's largest exporter, as goods and services move to the world's largest importer, the United States, what you see at the beginning of the river is going to eventually flow across the world to the end. So what starts in China ends in the US, and that's why we're so focused on what's going on with China right now, because things aren't looking good on a global scale. In fact, when you see this, what I'm going to show you today, I think you're going to be convinced that we're not long before we see a global recession. Let's head over to the data. And what are we first going to start with? The manufacturing and services PMIs. Now, what are these, in case you're wondering, if you're just tuned in for the first time? A PMI is a purchasing manager's index. It is a survey, so it is not hard data. It's a survey data. And then what it tells you, if it's at 50, it tells you there's no change over the prior month. If it's over 50 and the range over that tells you that it's an expansion. And if it's under 50, of course, the further under it goes, the bigger the contraction. So these are real important, because these survey data often gives us an idea of what the hard data is going to look like. So let's head over to China and see. We just got the survey data. In fact, we got quite a bit of it. We'll go through that later in today's show from the rest of the world. But we see their manufacturing sector has now slipped into a very tiny slight contraction over the month before. Now, that's not necessarily a big deal, but I want you to be looking here at when the last time it entered a slight contraction and stayed under there for a while was 2016. And then you see again, it came down here in late 2018. So keep that in mind. Now, the services sector, it popped up. It was in a bit of contraction. We do know that there were some more COVID shutdowns there. So it's popped back up to where it probably was headed anyways, which is in a downtrend at 53, saying the services sector is still in a slight expansion over the prior month. Now, we're going to again exclude the contracting month and just say overall the trend is still expanding, but at an ever slower rate. Now, this is a great chart that was posted on Zero Hedge and looked at the China PPI, or Producer Price Index, what factories are paying for prices, and then you see the CPI, Consumer Price Index, and there's virtually no relationship. These are on a year-over-year basis, and a lot of people believe that higher producer prices lead to higher consumer prices, and you can see that that isn't the case. Now, why does that tend to happen sometimes, which we'll get into, is just because prices go up at the factory level doesn't mean they can pass them on to the consumer. And that's one of the key things I want to impart with you today, is where we're going to go with this. But let's look at the bottom piece of this chart, and this is the CPI minus the PPI. So all they've done is take consumer prices and subtract producer prices. And what do we see here in 2000? What happened around the world? Oh, there was a dot-com bubble that burst. What then happened around 2004? Well, the U.S. stock market slowed down and didn't look like it was going to keep going higher. What did we have in 2008 when this dipped again? Oh, we had a great financial crisis. What happened in 2010 and 11? Well, we thought we were going to have a double dip recession. How about, this 2017, 2018, you can see up here, producer prices getting ahead of consumer prices. What happened again? Well, the stock market, we almost had another bear market. And now what are we seeing? This is way below all prior instances going back to 2000. And what is the broad belief right now of the stock market? That we're at the beginning of a secular bull market. So I want you to keep this in mind and frame this of what's going on in China and how it's going to flow to the US. So I thought, how cool would it be if we took the same information and applied it to the US and see what happened? So I did that. So here we have the consumer price index against the producer price index. And what you'll notice is that higher producer prices can push consumer prices up. But when producer prices are too high and stay too high and consumers can't afford them, prices come down. Now why does that happen? Well, see, a lot of people just assume that higher prices will be borne by the consumer. Many of the people that believe that have never owned a business, particularly ever a small business, because the small businesses feel this very, very sensitively as they adjust prices, because just because you have a business and you put inventory on your shelves and you price it at the price you'd like to sell it doesn't mean it actually sells. They're very sensitive to this. So what do you see a small business having to do? If they can't move inventory, they have to lower the price. So just because they pay more doesn't mean you always end up paying more, because if you can't afford it, they must lower their price because they've got bills to pay too. So let's take a look at what happens. You'll see that higher producer prices don't always lead into higher consumer prices. Now let's do some math and take the consumer price index and subtract the producer price index. Again, this is not year over year adjusted or anything like that. It's just subtracting the one from the other. And what do we see? Well, when it dips down, well, there was a recession. And then it went up and it came back down into 2004. The stock market had a little problem here. Then we had a great financial crisis when producer prices went berserk. Then we had a slowdown, almost a double dip recession here. There's another slowdown in the stock market, another one here. And now we're off to the races, apparently, in the equity market, as we're seeing already the same signs that we saw in China going back here, that it's leading the U.S. of where this is going. So I overlaid the stock market so you can see that it comes down. The stock market's not happy about it. Then it goes back up as this starts to come back down again. The stock market fights it, and finally says, no. You see in 2004, it flattened out as it was coming down. And then all of a sudden, the stock market finally bowed to the data. The great financial crisis. Here's your double dip recession. Here's Brexit, where we had a little problem there as it dipped down a little bit, not too much. Maybe it got a little too fast. Here's the 2018, where we almost had a bear market. And now again, the belief is we're off to the races here. And if you're not in it, you're not going to win it. And once again, what we're seeing is the problem is prices are moving too high. And in the bond market, what we don't see quite the same relationship. In fact, you look at this, you really don't see much of a relationship at all, other than we know recessions, interest rates go down, and we can see during recessions, again, that it followed it with quite a lag. So there's really not much of a correlation there, and we see here not much of a correlation. Maybe they're somewhat inverse. I probably can check that, but you don't see much of a relationship in this chart at all. But now this is where it starts to get interesting, because this is the non-farm business sector unit labor cost. Now, what is a unit labor cost? It's what a business pays for a unit of labor. That's going to be your wages, benefits, and all those things included. And of course, the belief is that if wages and for employees are going up, they can afford the higher prices, right? It makes perfect sense. When you get a raise, you can afford more stuff. So let's take a look and see if this is true and where this is telling us the U.S. is headed. And sure enough, as the year-over-year rate of change in blue, the unit labor costs rise, what happens? Consumer prices rise with it. But when unit costs get out of control for businesses and prices aren't being absorbed by the consumers, well, they both come down. And you can see, here's a case where consumer prices get out of line and wages aren't going up enough to hold it. And that becomes a problem. So you have this case over and over where prices are going up too fast and wages aren't going up enough where consumers can afford them. And then you have instances like the great financial crisis where consumer prices are going up and unit labor costs are going down. And look what happens. Consumer prices in red come crashing lower. And look what's happening now. Consumer prices up. Where's unit labor costs? Can you see that in the corner? It's almost at zero on a year-over-year rate of change. So what it's telling us is what we know, what we see in China already is happening in the U.S., where wages are not keeping pace. And what is the likely direction for consumer prices? Lower. And then we can even look at this. So again, are you starting to see the seeds being sown for a global recession here? All this inflation is not turning out to be growth-led inflation. It's turning out to be the worst kind of inflation, the kind that people can't afford. And when they can't afford it, well, they stop spending as much money. So here are real hourly compensation for all employed persons. And real means inflation adjusted. So it's already been adjusted for inflation. And in red, we again have the consumer price index, both on a year over year. And look at this. We can go back even to the 1970s. So consumer prices were rising out of control, which everyone thinks is going to happen now and never stop. And look what happened. Real compensation went down. And what does that mean? They couldn't afford it and prices came down, and then wages went up. So prices shot back up in the 70s again, and inflation adjusted wages went down. Inflation starts slowing down. Wages come back up, boom, all of a sudden prices shoot higher again until wages aren't keeping up, and then boom, inflation, disinflation all the way down. And we see this over and over again where consumer prices get out of control compared to inflation adjusted wages, and that means those higher prices get rejected. And look at where we're at now. You see the consumer price index is way up here, similar kind of where we were in the great financial crisis. What happened during the great financial crisis? Inflation adjusted wages contracted. Oh, where are they at now? Oh, the largest contraction since the 1950s. So do you think consumers can afford this? And then you start doing some math. When we talked about all those ships sitting in China waiting to get loaded with goods to come over to America. And now we're sitting off the port of Long Beach in Los Angeles. 70 ships waiting to import disinflation. And you look at the data, and when those goods and services eventually gets to shelves, what do we already know? People will not be able to afford them. Businesses will then be under pressure to lower prices, go back to wholesalers to push prices, to ask for concessions, who will go back to manufacturers, and that's how you get a deflationary shock. And you can see it now, all because of what we saw in China. And now, how does that map out to the stock market? Well, here's the NASDAQ McClellan Summation Index. Despite people bidding stock prices higher today, this is telling you that the breadth of the NASDAQ is likely to head lower. In fact, normally when it's at these levels, it signals a massive risk-off move in stocks, but we keep seeing investors want to buy. Here's another great indicator, and this is the percentage of stocks in the S&P 500 that are above their 50-day moving average. Now, if you're not familiar with what that means, is it takes the average price over the last 50 days and looks at what percentage of stocks are trading above that and what percentage are trading below that. And again, this is a breadth indicator. So when more stocks are trading below it, it's bearish. When more above it, it's bullish. And what do we see now over the last 5 years? When it gets down into this range, it usually signals a bottom, which is probably why people are coming in and buying, but it doesn't mean it can't go lower. In fact, what the bulls want is this to bounce back up and drive the index higher. But now let's look at this same thing, because you can see it's got to, you want to find a major bottom, look for a 3 standard deviation move lower. And we're not quite at 2 standard deviations, which is generally considered a pretty good place to buy. But look at now when we go back over the last 200 days, take the average price of these stocks over the last 200 days and look at what percentage of them in the S&P 500 are above their 200-day moving average. And now we get a more interesting picture where we see the percentage of stocks over their 200-day moving average are headed down. So that means more stocks are starting to trade below their 200-day moving average, and you can see as that heads down, it becomes a major risk off. This is why it's called breadth, because it tends to lead the major indice here, and when it gets down to a minus 3 standard deviation move, it's a buy. So the 50-day is suggesting that perhaps there's more to come because the 200-day is not bouncing like it needs to validate there's a short-term bottom here. And that indeed, my friends, is how you can see, starting back at China and moving all the way across the pond to the U.S., and how we're likely to see a global recession here in the not too distant future. Now, we do know that Congress finally passed a stopgap budget. So now until December 3rd, there's at least some time. The Treasury will be able to raise some money that will pull liquidity out of the economy. Now, many people ask, how can this be bond bullish? Well, First, let's hit the story here. We see Biden signs government funding bill to avert a shutdown. This does not mean we actually have a budget. You just now have until December 3rd for them to figure something out. They could figure something out this weekend, next week. Who knows? And it could get done before then, but at least for now, the Treasury can raise some money to keep paying bills. That will pull liquidity out of the market. But why did we see such a negative reaction in the bond market? And I'm going to publish a piece at 5 p.m. Pacific on Facebook, LinkedIn, and Twitter. It'll also be on my blog, so you can follow up with that. It's not linked in the description because this is being filmed at before that, but you can go check that out. There'll be links to all my social media in the description below. But here's what I'm thinking, and then you can kind of read up about more of my thoughts on this, is there was real fears that the government was going to enter a technical default, and that's not something that normally happens. So those who are holding T-bills, Treasury bills, and why do they have them? Well, they mature very quickly, then they become cash. Well, what if the government technically defaulted and didn't pay the redemption fee on those T-bills? That means someone who was counting on their redemption for cash wouldn't have it. So what did they do? Well, they started selling notes and bonds to raise cash under the expectation the government was going to default on the bills and make up for it later, but they still needed the cash now. So it starts to make sense of why we may have seen this. And now you're going to probably answer this, well, what about the standing repo facility? Didn't the Fed do that to solve this problem? They did. But guess what? Only security dealers have access to it right now, and that is part of the problem. Over time, the standard repo will be expanded to have more participants, but for now, there weren't. So people got worried about it. So how does this turn out to be bond bullish? Is because now that we have a stopgap bill, that means the selling pressure on those notes and bonds to raise cash is going to go away, because those bills are now going to get paid interest and hit maturity where they can be converted to cash, and then that cash will eventually go back into those longer term notes and bonds. Not to mention this great piece that was posted on Twitter from Cornerstone Macro, and what they looked at was the Treasury notes and bond issuance versus Fed purchases. Now, you've heard me say that Fed purchases, that Treasuries, the Treasury is going to reduce its issuance of notes and bonds going forward because they expanded it during the CARES Act. Well, here this is great, because what this shows is Fed purchases projecting in light green the Fed's going to be purchasing less. Well, we'll see if they do that. How about Treasury net issuance? Well, it's going down, so the issuance net of Fed purchases is declining. So even if the Fed tapers, which I still don't think they're going to do, but they might, due to the reduction of issuance, it's still bond bullish. Isn't that pretty cool? But the question then becomes, is the Fed going to taper? Well, we're going to find out about a payroll report pretty soon. And according to MNI Market News, the St. Louis Fed model sees a loss of 818 jobs in September. Now, this is still fairly new. I'm still gathering detail on this. In August, they came and nailed that call as well. But let's look at the unemployment data, which is trending back up. Now we're moving into the October data series for the non-farm payroll. These numbers will now float into October. But despite employers saying they're desperate to hire, they laid off even more people this last week. And that is a red flag. We also see over 6 million people dropped off the pandemic claims, which we've expected to happen. And now those people don't have that extra income anymore. They may not have any income. The question is, are they going to get jobs, or is that lack of income going to start showing up into the economy? And now there are 5 million people on some form of total claims, and that number should continue to drop back to normal levels in the weeks that come. So that is a concern, because now we start getting into the factory data. So you kind of get the picture, right? You see the slowdown start in China. It comes over to the U.S. The market breadth is starting to tell us that there's problems there. We know now due to the stopgap bill, the Treasury is going to start pulling liquidity out. When the debt ceiling is officially raised, they're going to pull more liquidity out as Yellen seeks to increase the cash balance of the Treasury's general account. And then we look at the unemployment data and say that's not going the right way. And now we got to look at the factory data and see what's over there. And what do we see from the Dallas Fed? Business activity heading up. And what do we prices received heading up and business activity heading down? And the last time that happened, there was something called the Great Financial Crisis. I think we've kind of made that story there. Now let's look over to the ISM manufacturing index. or manufacturing purchasing managers index. And what do we see? Slightly increased in the PMI for September, showing the manufacturing sector in the U.S. expanded just slightly over the prior month at a faster rate, a slightly faster rate. New orders unchanged, production slowed down a little bit, employment up a little bit, almost unchanged. So in terms of looking for big hiring from the manufacturing sector, not going to see it. Supplier deliveries took a little bit longer. Inventories expanded at about the same rate. Customer inventories contracting at the same rate. So customers keep saying they're desperate for inventory, but we'll see how long that lasts when all that cargo comes off the ships. Prices paid ticked up, but still below its peak. Remember, peaks in ISM prices paid tend to match with a lag peaks in Treasury yields. So that's, again, there's further validation that yields have indeed peaked. Backlog of orders, this is where you get inflation from. That number is slowing. So that is good news from a disinflationary standpoint, bad news from a growth standpoint. What do we see here? The prices paid index rolling over, heading lower. That tends to lead to CBI down. Also signifies a peak in Treasury yields, which we already know is in. And then we can see the ISM versus the market versus the City Economic Surprise Index. And all the City Economic Surprise Index is when an analyst or an economist estimates where a piece of economic data comes in. If the data comes in below their estimate, the surprise index goes down. Hence the idea of they're surprised. And if the data is above the estimate, then it goes up. And that's suggesting that economists are too optimistic, and that means the survey data is indeed likely to head lower. Anyways, as always, thanks for being fans. Thanks for subscribing. Thanks for liking. Thanks for following the show. But now you see the big picture of how it's going on with China could lead to a global recession coming fairly soon if that unemployment data holds true. Anyways, I'm Steven Van Metre. We'll see those of you who watch the Sunday show back on Sunday. And if not, I'll see you on Monday. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investor or other advice. Shares not to be construed as recognition or solicitation by or selling security, financial instrument, or participating in a particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.